No consultant in the world is going to tell you just buy an S&P index fund and sit for the next 50 years. You don't get to be a consultant that way. And you certainly don't get an annual fee that way.
The biggest secret in investing that no one tells you is that simplicity is the key. There are only 3 considerations and 3 investments you need to bother yourself with for your investments. This will radically simplify your investments and you'll be ahead of 95% of all the professional active managers. This number is based on research by Standard & Poor's. You need to consider 3 things before designing your portfolio. 1, the stage of investing you're in. 2, how much risk you're okay with. And 3, your investment time horizon. As you might have guessed, these 3 considerations are closely linked. Your level of risk will vary with your investment horizon. If you are long-term oriented, you can take more risks. Both risk and time horizon affect which stage of investing you are in. All 3 will be linked to your current employment and future plans. Only you can make these decisions. Here are some things that can help you guide your decisions. As far as the stages of investing are concerned, there are only 2: wealth building stage or wealth preservation stage. There is no wealth spending stage. Even after you retire, you should only spend the income you earn on your assets, while preserving the asset values on an inflation-adjusted basis. The dream scenario where you spend the last dollar of your savings on the day you die, so that you fully use up all your assets and die with 0 balances after having lived your life to the fullest, is appealing only in theory. We don't know which day is our last, so that is not possible in practice. Even if you know when you will die, I wouldn't bother trying to die with 0 balance, because the most important thing that money can buy is freedom, not pleasure you get from stuff or experiences. Even if you bury your savings in your backyard because you don't want to lose it in the volatile stock market, you are exposed to inflation risk. Your cash would be worth a lot less after a few years because inflation eats into the purchasing power of your money. If you save in stocks, commodities, or real estate to protect yourself from inflation, deflation might erode your wealth. I made a video about inflation and deflation risks. Check it out if you want to know more. You might plan to retire early. You might be worried about your job. Which stage you are in, wealth generation or wealth preservation, is not necessarily linked to your age. What if you want to retire early, or you're worried about losing your job, or you actually lose your job? You might want to take a sabbatical, or you might return to workforce after several years of retirement. Your life stages may well shift several times over the course of your life. Your investments can easily shift with them. Try to earn a few money as soon as possible by saving more. The obvious benefit is that the greater the percentage of your income you save and invest, the sooner you'll attain financial freedom. The not so obvious benefit of a high savings rate is that it gives you options and flexibility to live your life on your own terms. It gives you time to think and the ability to wait and pounce at the right opportunity. The interest or dividends you earn on your savings is nothing compared to the option of changing careers at the right time or retiring early, or freedom from worry. This flexibility that savings give you is increasingly important in a hyper-connected world, where you compete not just with hundreds or thousands in your city, but with millions or billions worldwide. If you are in your 20s, you almost have the whole life ahead of you. Even if you are, say, 50 years old, don't invest 50% of your invest in bonds, as the common advice goes. The typical investment advisor's rule of thumb is to subtract your age from 100 or 120 and invest the resulting number in stocks. So if you're 60 years old, subtract 60 from 100 and invest only 40% of your savings in stocks, with the remaining 60% going into bonds. Life expectancies are increasing, and at 50 you can expect to live for at least another 30 years. That is a long time. Even modest inflation for a few years is terrible for bond investments. What if you have a younger spouse? Or what if you want to leave some money to your kids or even grandkids, or give to charity? So think long term and don't decide to invest in bonds lightly. Be biased in favor of stocks. Once you have sorted through your 3 considerations, you are ready to build your portfolio, and you'll need only these 3 assets from only one company: Vanguard. Vanguard Stock Index Fund, Vanguard Bond Index Fund, and Vanguard Money Market Fund. Don't bother about picking individual stocks, real estate, gold, fixed deposits, or derivatives, commodities, and cryptocurrency. None of those are required. These 3 Vanguard funds are all you need. The Vanguard Stock Market Index Fund is a core wealth building tool and a hedge against inflation. I spoke about this multiple times in my earlier videos. Check this one for more. Investing in stocks is your best bet to grow your wealth. They offer the highest returns among all the other asset classes. And buying a low-cost diversified index fund is the best way to invest in stocks, not by trying to pick individual stocks. Vanguard index funds offer the best returns, take the least amount of effort, and is the lowest cost option. It's important to remember that stock markets are very volatile. You can expect the stock market to fall by 50% every 10 years. When that happens, don't sell. Just toughen up and ride it out. Vanguard Total Bond Market Fund provides income, and they smooth out the rough ride of stocks. Bonds are also an excellent investment during deflation. Deflation is when prices come down and consumers postpone their purchases, hoping to buy at lower prices in future. This is terrible for the economy. America suffered deflation in the 1930s and came very close to it after the 2008 financial crisis. I made a video explaining why it happens and what you should invest in during deflation. Check it out. The downside for bonds is that during times of inflation or when interest rates are rising, they get hammered. Any savings you need for the short term, that is less than 5 years, or funds for emergencies, you should hold them in cash. You can invest in a money market fund, which might give you a slightly better return than depositing in a bank. Vanguard again has a money market fund, VMMXS. You should consider it. Like bonds, cash is also king during times of deflation. The more prices drop, the more your cash can buy. But idle cash doesn't have much earning potential, and when prices rise, its value steadily erodes. Now that you know about the 3 considerations and 3 investments you need to simplify your investments radically, here's why you should only deal with Vanguard. Vanguard has a unique structure and is client-owned, which means Vanguard funds, and by extension the investors in those funds, are the owners of Vanguard. It ensures alignment of interest. As an investor in Vanguard funds, your interests and that of Vanguard are precisely the same. Every other investment company has 2 masters to serve. The company's owners, interested in charging high fees and making a profit, and investors in their funds, who benefit from low fees. The average expense ratio at Vanguard is 0.2% since it is operated at cost. The industry average is 1.2%. It might not sound like much, but over time, they make an enormous difference because of the power of compounding. Even if you find another fund with low expense ratios, you can't trust these other companies long term. You might find an index fund from another investment company that is cheaper. They create some as loss leaders, but you can't trust these other companies. Like Dave Ramsey says, if you play with snakes, you'll eventually get bitten. If you like this video, I recommend that you watch this one, where I explain 4 beginner investment mistakes that you should avoid that will put you way ahead of professional investors. I'm Sharath Mantravadi. Thanks for watching.